Elon Musk can't buy a yacht. Not because he's broke, he's worth $200 billion, because almost none of that is actually money. It's shares in a company, numbers on a screen, wealth you can see but can't spend. So what do billionaires do when they want to buy something? They borrow. Not because they're broke, because borrowing is cheaper than spending. The richest people on earth would rather owe money than use their own. Here's why that matters to you. Here's the thing that throws everyone. When you hear Elon Musk is worth $200 billion, your brain pictures a bank account with that number in it. It doesn't work like that. Almost all of that wealth is tied up in Tesla shares, SpaceX equity, and other assets. If Musk wanted to buy a house tomorrow with cash, he'd have to sell shares. Same with Jeff Bezos. Same with every billionaire you've heard of. And here's where it gets interesting. The moment they sell those shares, the tax office shows up. In most countries, selling an asset that's gone up in value triggers something called capital gains tax. Basically, the government's cut when you make a profit. Depending on where you live, that could mean handing over 20, 30, even 40% of the sale to the government. So if a billionaire sells $10 million worth of shares, they might only walk away with $6 or $7 million after tax. You can see the problem. Selling assets is expensive, not just in fees, in taxes that bite the moment you convert wealth into cash. So the ultra-wealthy found a workaround. They don't sell, they borrow against what they own. And that loan? Not taxed. Debt isn't income. You can take out $10 million against your shareholding, spend every cent of it, and the tax office doesn't get a dollar. That's the first reason billionaires borrow. It's a tax dodge that's completely legal. But avoiding tax is just the appetizer. The main course? They actually profit from the debt itself. Now, you might be thinking, sure, but loans cost money. Interest rates, fees, all that. You're right. Except when you're worth hundreds of millions, the cost of borrowing isn't what it is for the rest of us. Let's say you walk into a bank and ask for a loan. The bank looks at your income, your credit score, your job security. If you're lucky, they'll lend you money at maybe 6, 8, 10% interest. If your credit's shaky, it's higher. But when someone like Bezos walks in, or more accurately, when his wealth manager makes a call, the bank sees something very different. They see collateral. Billions of dollars in assets. Zero risk of default. So they offer rates most of us will never see. Sometimes 3%. Sometimes lower. Here's why that matters. If you can borrow money at 3% and your investments are returning 8 or 10%, you've just made money by going into debt. Think about that. You take out a loan at 3% interest. You leave your investments alone, and they keep growing at 10%. You've made a 7% profit on money you borrowed. The more you borrow, the more you make. That's leverage. And when you're wealthy, leverage isn't risky. It's a money printer. This is the mindset shift most people never make. For most of us, debt means we couldn't afford something. For the ultra-rich, debt means they found a cheaper way to pay for it than using their own money. Honestly, that flipped my brain the first time I understood it. We're taught debt is failure. For them, it's just maths. Say you own $50 million in shares. Those shares are growing at 10% a year, which is roughly the long-term average return of the stock market. That's $5 million a year, enough to buy a house in Sydney every couple of months without you lifting a finger. Now, instead of selling those shares to buy something, you borrow $10 million against them at 4% interest. That loan costs you $400,000 a year in interest. But your $50 million in shares? Still growing. Still making you $5 million a year? You've accessed $10 million in cash. You're paying $400,000 to keep it, and your wealth is still compounding. You're spending money and getting richer at the same time. This is what financial advisors mean when they say the wealthy use debt as a tool for wealth creation. It's not about being unable to pay. It's about recognizing that borrowing cheap money to keep your assets working is more profitable than cashing out. Critics argue this creates an uneven system. Someone working a job pays tax on every dollar they earn. Someone living off borrowed wealth pays tax on almost nothing. The labor gets taxed. The wealth keeps growing. Two different games. Same economy. Here's where it gets almost absurd. Once you've borrowed against your assets, you can just keep doing it. Your shares keep growing. A few years later, they're worth more. So you borrow against them again. You use that new loan to pay off the old one, or to fund more spending. And the whole time, you never sell. You never trigger a taxable event. You just keep deferring. There's even a term for this in wealth management circles. Buy, borrow, die. You buy assets. You borrow against them when you need cash. And when you die, those assets pass to your heirs under different tax rules, often with a step-up in basis that erases the capital gains entirely. Your heirs inherit assets worth $1 billion. The tax office treats them as if they were bought yesterday, and nobody ever pays tax on decades of growth. It's not a loophole in the traditional sense. It's just how the system was built. Here's the bit that surprised me. In 2021, ProPublica found that some of the wealthiest Americans paid zero federal income tax in certain years, not through fraud, but through this exact strategy. Bezos in 2007. Musk in 2018. Legal, documented, and entirely invisible to most people. Honestly, this one bugs me. Not because it's illegal, it isn't, but because the gap between the rules for earned income and the rules for wealth feels designed. You work, you pay tax immediately. You own, you defer indefinitely. So why doesn't everyone do this? Simple. You need wealth to borrow against. If you're worth $50,000, no bank is lending you $10 million at 3%. They're not lending you anything close. The system rewards people who already have assets. The more you own, the cheaper it is to borrow. The cheaper it is to borrow, the faster you can grow what you own. It's a feedback loop that accelerates the higher you climb. And that's the quiet part. Borrowing isn't just a strategy for the rich. It's a mechanism that keeps them rich. Someone starting from zero has to save, invest slowly, pay tax on every gain, and hope the market cooperates. Someone starting from $100 million can borrow against it, reinvest the borrowed cash, and grow wealth without ever spending their own money. The more you have, the less you need to use. Remember that paradox. You're worth $200 billion. That's roughly the GDP of New Zealand, locked up in your name. You're one of the richest people alive. And yet, if you walked into a car dealership tomorrow and tried to buy a vehicle with cash, you'd struggle. Because your wealth isn't liquid. It's locked in company shares, property, private equity. Selling it is slow, expensive, and visible. Everyone sees when a billionaire sells shares. The market reacts. The tax office watches. So instead, you call your bank. You borrow $5 million at a rate lower than inflation. You buy the car, the house, the whatever, and your $200 billion? Still sitting there, still growing, untouched. You've spent money without spending wealth. That's the trick. And it's only a trick if you're already rich enough for the banks to trust you with it. Which brings us back to the hook. Elon Musk can't buy a yacht with cash. Not because he's broke, but because staying rich means never actually spending your money. Now you know why. So let's be honest about what this means for you. You're not going to borrow your way to $1 billion. This isn't advice, it's observation. But understanding how the system works changes how you see the headlines. When you hear billionaire net worth hits new record, you now know most of that wealth was never at risk. It was never sold. It was borrowed against, spent, and left to grow while someone else covered the tab. And when you hear debates about taxing the rich, you'll understand why it's complicated. Wealth isn't income. It doesn't flow through a payslip. It sits, compounds, and gets accessed through loans that never show up as taxable events. The rules weren't written for that. They were written for people who earn and spend. The ultra-wealthy do neither. They own and borrow. You're playing a game where earning is taxed immediately and owning is taxed eventually. Maybe. They're playing a game where owning is never taxed as long as you never sell. Same economy, different rules. And here's the uncomfortable bit. Nobody hid it from you. It's just that most of us were never in a position to need to know. So the question isn't whether they should pay more tax. The question is, why do we still call what they do income? If this changed how you see wealth, there's more where that came from. Next time, we're looking at why being poor actually costs more. And I mean literally, in dollars, you can count. Hit subscribe so you don't miss it. That's money, actually.